think it's actually less risky for someone to get involved in real estate than it is in the stock market. I think most people could explain real estate easier than they could the stock market. A stock can go to zero. Real estate is not likely to go to zero. How does depreciation work?
So that's a trade-off, because if you're not paying tax on the income, when you're buying a property or buying really any asset with your IRA, it is your IRA account as its own entity that is making the purchase. So if it's a rental property, your IRA is actually on title. The rental income going back to your IRA is going back tax deferred. And since your IRA is not paying tax on that income at this time, you lose depreciation, the ability to take any depreciation or other deductions. That is one downside of having an IRA by real estate. The upside, you're not paying tax on the income. The downside, you're personally not getting the income, correct? Because it's going back to your IRA.
The thing that stinks with an IRA is the exit. Like, I love real estate because of the tax benefits that the IRS gives me. When it's wrapped inside the IRA, I lose a lot of those benefits, and the exit can be a nightmare. You know, I started in this career when a friend of mine inherited his mom's IRA when she passed away. And at the time, you could do a lifetime or a 5-year distribution. So he did it over 5 years on top of his own income. And so the tax deferral that we talk about and the tax savings that we hoped for didn't exist because he took it all out in such a short period. And now the IRS requires it, like you said, over 10 years on top of your existing income. What's up, everybody? Welcome to another episode of Cash Flow Conversations. Today I have Scott Maurer with us, who is calling in from Tampa Bay area, Florida, who is helping people in a very unique way that I am very curious about. He helps people with what's called self-directed individual retirement accounts, or self-directed IRA. Scott, it's good to have you here, dude.
Thanks, Matt. Appreciate being on.
So some people might not even understand what an IRA is. So let's start like super high level. An IRA stands for individual retirement account. Walk me through that. How does one do that?
Sure, no problem, Matt. So IRAs, kind of, again, starting at a very high level, we can dive into what a self-directed IRA is, but at the very high level, an IRA, or as you mentioned, individual retirement account, is basically, it's, as it says, it's a retirement account for an individual, as opposed to, many people are familiar with 401ks, which are retirement accounts you get through your employer. But an IRA is one in which you can create one for yourself. It is a tax deferral and potentially tax saving strategy. Actually, I guess it's a tax saving strategy regardless, but it's a way that really, when they were created back in 1974, at that time, Congress, having some foresight at that time, wanted to provide a mechanism for people to save for their own retirement and be less reliant upon the federal government, Social Security, for anything they would need in their older ages. So they created the IRA as a tax-advantaged way for people to save money for their own retirement. You can put money into an IRA account. You can get a tax deduction for putting money in, so taking money out of your own pocket, adding it to your account every year. The growth, as you invest and reinvest in whatever assets you choose, that growth continues to be tax deferred, which allows you to simply compound your money more quickly over time. With many IRAs, you then will eventually pay taxes on money as you pull it out in retirement. So you're not required to take money out until you're into your 70s. So you can start putting money in, getting tax deductions, getting tax deferred growth throughout the course of your entire lifetime, hopefully building up a nice nest egg, so that when you do hit those early 70s and you start pulling money out of the IRA, again, you have more money to pull from, and the more money you have of your own, the less you will rely and need on government services. So IRAs are kind of a tangent to 401k plans. And in fact, people who have 401ks, when you leave an employer, you can roll that 401k into an IRA and get a lot more control over what you choose to invest in.
So for anybody listening to this show, I did not bring Scott on here to ambush him and challenge everything he just said. I actually am curious because I believe what Scott is doing is actually bringing control back to people who have existing IRAs. So if you listen to this show often, you'll understand I really beat up qualified retirement plans. And we can get into that later if you want to. We'll go back and forth. We'll have a little exchange, sure. A friendly exchange. But what I wanted to focus on is, so you mentioned, so through my employer, it's called a 401k, 403b, something through the job site. And if I leave that job site, then I can roll that retirement account into an individual retirement account, right?
Correct.
And you can have, then it opens up to a world of different investment types. So with a 401k or 403b, you're usually limited by what you can choose. And so the individual side, you can get more customized. And so what you guys focus on, the way that I understand it, is real estate, right? Are you advocates of real estate, or do you really don't even care what they get into?
Yeah, I mean, kind of, we don't necessarily care as long as they stay within IRS guidelines. So that's what most people don't understand about IRAs and even 401ks to an extent, is most individuals have their IRA, they have a 401k maybe through an employer. As you said, you're limited to maybe mutual funds, stocks, investments of that type. But the IRS rules will allow you to invest in a wide variety of assets, but not every custodian will hold every asset. So practically speaking, I think probably 65, 70% of the assets that we hold at Advanta IRA on behalf of our clients are real estate in nature, whether it's a single family home that someone's renting out, whether you're investing in a multifamily or commercial property as a kind of a limited partner. You can lend money from your IRA to somebody else who's investing in real estate. So a lot of what we do is tied to real estate. Outside of that realm, people invest in oil and gas bonds, um, private equity funds, startup companies. Again, there's a lot of different things you can do. You just have to have a custodian willing to hold it. And that's really kind of the niche we serve in the retirement plan industry, is holding these unique assets that a Schwab, a Fidelity, a Vanguard are not going to hold on their platform. Again, not because it's illegal, just because they choose not to.
And so your company is called what?
We're Advanta IRA.
Advanced IRA, and so you are what's considered then a custodian.
We are. We act as a custodian for those, like I said, unique alternative assets.
And so here's my pitch for Scott's company, guys. My one of my biggest complaints that is in my book is the financial industry managing pre-taxed accounts and charging fees on money that the IRS hasn't gotten their fair share of. You guys have a flat fee. So your structure is totally different, right? And walk me through this. The account size doesn't matter, right?
Correct. So if you're investing in, say, a $50,000 property, or you're putting $500,000 into that same type of investment, we charge a flat $295 a year fee. So it's an administrative and record keeping fee that we charge. We do not charge a percentage of assets. We do not charge commissions based on what we do. Our fees are strictly administrative and record keeping. There might be like
How can you make,
$150 or so in getting account open, but yeah, $295 a year.
bro? Let's just be honest here. That seems so small. Like, what if someone's got a $500,000? It's only $300 a year.
It is $295 per asset. So if people were dividing that $500,000 up into a couple different assets, they might be paying $295 for each one.
Well, let's
But
do
there
that
are
here really
yeah.
quick. Let's say they have a $500,000 in an IRA, and the advisor's charging 1%. They're making five grand a year.
Yep.
Let's say someone has 500,000, and then they have 5 assets with you. They would pay
$1,500.
Dude.
Yep.
I think that is such a wonderful. Here's why I love Scott's service. You're teaching people how to control their assets that they're invested in. I think it's actually less risky for someone to get involved in real estate than it is in the stock market. I think most people could explain real estate easier than they could the stock market. A stock can go to zero. Real estate is not likely to go to zero. So it's less risky. The people can see what they're actually invested in, and you're not raping them with a massive fee.
No, and I mean, I think you touched on that. One of the things that draws people to what we do is that control factor, and it's the investing in what they know. Like you said, people probably understand real estate more intrinsically than they would a mutual fund or a stock, and how that works, or the hidden fees or hidden costs that they just don't see in those funds. As opposed to, I can go buy a rental property, buy it, pay cash, rent it out. The cash flow just comes right back into my IRA. Now my IRA is growing based on the cash flow each month. And
So,
if I got that property at a good value and I sell it 5 years down the line, I've also got the appreciation on top of that. All coming back again, tax deferred to the IRA account.
So really quick, so because it's in an IRA, let's say I'll buy a house inside of my IRA. So we have a self-directed IRA that owns a single family home. The cash flow from that house does not go to the owner of the IRA. It stays inside the IRA, correct?
Correct.
And is there like a separate cash account that it just goes into, like a bank account that's called an IRA?
Well, it goes into their IRA account with us. So we manage, part of our fee every year is we're receiving any income for the property or the asset back into the IRA. If there's any expense related to that asset, the IRA is expected to pay that, and we handle the cash flow coming in and out. So the cash comes back into the IRA. So they looked at, if a client looked at their account statement with us, they'll show the real estate holding and its value, and then they'll show their cash and any available cash they have with us as well.
So I have a number of questions here. This is really good. So what if there's a lack of cash in the IRA and there's maintenance or something that needs to take place in the property?
Good question. So that's where you would want to make sure that if you have other IRAs elsewhere, you could always transfer additional funds over to cover any expenses. A lot of our clients maintain multiple IRAs. They have an account with us with real estate. They have an account with a brokerage firm holding mutual funds and stocks. So you're always permitted to move money between IRAs as often and whenever you'd like. So that is potentially one scenario. You could also make your annual contribution to the account up to your limits. The IRS sets each year. You could put more money into the account to pay an expense.
What if I'm at my limit for the year?
Yeah, I was gonna say, absent those scenarios, the other issue that would be a potential issue where you'd either have to look at bringing in a partner, potentially looking to get an equity line out on the property. There are lenders who will lend to IRA accounts as long as you have enough equity in the property, which if you've paid cash for it, you have plenty of equity then to draw money out to pay those expenses. I would also caution someone saying that's probably potentially poor planning up front, that when you're looking to buy a property, especially one where there's going to be expenses, you want to make sure you're leaving yourself a cash cushion for that exact scenario before you get the rental income coming back in.
So that's a potential red flag down the road.
Correct. It's definitely an issue to consider, especially when you're getting started and figuring out what you need to buy the property and how much cash you're going to need to have on hand going forward.
So my company is Cash Flow Architects, and I want to really focus on people getting cash flow before retirement years. And so there's a little bit of conflict of interest, I think, of what you guys do and what I teach, but I don't think it's that large, because I think you're still super cheap and giving the control back to the consumer. How does depreciation work?
So that's the trade-off, because if you're not paying tax on the income, so it's the important thing to remember when you're buying a property or buying really any asset with your IRA, it is your IRA account as its own entity that is making the purchase. So if it's a rental property, your IRA is actually on title. The rental income going back to your IRA is going back tax deferred. And since your IRA is not paying tax on that income at this time, you lose depreciation, the ability to take any depreciation or other deductions. That is one downside of having an IRA by real estate. The upside, you're not paying tax on the income. The downside, you're not being able to avail yourself that depreciation. Correct. Well, yeah, you're personally not getting the income, correct, because it's going back to your IRA.
And so RMDs, 72 years old, required minimum distributions. The IRS says you've been postponing the tax bill long enough. Now you got to start taking money out. How does that work?
Correct. So RMDs, just like they would with any other retirement account, are figured and calculated based on the fair market value of your IRA at that time that you have to start taking your RMDs, and divided by your life expectancy figure at that time. So usually it's about 3 to 4% of your total taxable IRAs that you must distribute once you hit RMD age. Now, for hitting that amount, it's obviously easiest to take cash out. So if you have cash reserves in your account, or you have other IRA accounts where you can satisfy your RMD, it is easiest to take those distributions out of those accounts and not touch your kind of illiquid real estate or other type of asset. But they work just the same. The IRA accounts we have are the exact same contribution limits, distribution rules. The difference is the investments you're putting inside the account.
So would it force the sale of a property potentially?
Not necessarily, because I've seen it happen only in probably once or twice in my 18 years of doing this, where somebody got to the point where their RMD requirement was more than they had in cash in their account. At that time, the client actually distributed a percentage of the property from their IRA to themselves. So the IRA property went from being 100% owned by the IRA account itself to, say, 95% owned IRA, 5% personally. And then going forward, you share the income and expenses along that same percentage. So there are ways you're not stuck. You don't force a complete sale. You just may force a distribution of a percentage of the asset.
Okay. Interesting. Talk to me about what happens at death.
At death, I mean, just again, as with any other IRA, you would have left and designated a beneficiary when you open up the account with us, and that in the assets you hold then pass to that beneficiary. If it's a spouse, and you're leaving your IRA to your spouse, they can take that account simply as their own IRA and just move the assets and title from your name to your spouse's name. They now have their IRA just as, again, subject to the other rules. If you leave your IRA to a non-spouse, since 2021, I believe the rules are now different, where if you're a non-spouse beneficiary, child, friend, other relative, you must distribute the IRA account within a 10-year period. So you're required to fully distribute the IRA over the next 10 years. Basically, the IRS is accelerating the payment of those taxes. Prior to 2021, and if you inherit an IRA prior to that time, you actually can stretch your distributions out and stretch that account over the course of your entire life. So you do not have to fully distribute in 10 years. But for anyone who inherits after 2021, you must fully distribute the account in that 10-year period.
I think we brought a lot of clarity to how self-directed IRAs work. Anything else that I didn't ask about that's important to touch on?
Yeah, I think one thing I always like to mention with the self-directed IRA, and it's kind of intrinsic there in the name, is it is a self-directed account, which means if you're making an investment into real estate or a startup company, private equity, et cetera, it is incumbent upon you to do your due diligence on the investment. Unlike financial advisors, we are not advising you on the assets that you're purchasing within the account.
Which is another
So it's
reason
up.
why I love what you guys do. You're
Right. No,
saying this is your baby. We'll just help you wrap it up and package it.
exactly. So yeah, it's going to be up to you to make those determinations. Our job is going to be to make sure documents are properly titled, that money is flowing the proper way to keep your account completely tax protected. But it's up to you to do all your due diligence and be comfortable with the investments you're making.
I'm going to make sure that we have a link for your website in the episode and on YouTube so people can come and check you guys out. I think what you guys are doing is great, dude. I really do. My pushback is I think by default, most Americans just fund a retirement account because they think that's what they're supposed to do. And I think what you're doing is you're giving them a way out of Wall Street and showing them how to control their assets in a different asset class that I think is bound for success over the next for the rest of our lives. I don't think real estate will ever be going down
Right.
because my thesis on real estate is I believe in 30 years, people are still going to want to sleep inside. So I think it's a good place to go. My challenge is, and the thing that stinks with an IRA is the exit. Like I love real estate because of the tax benefits that the IRS gives me. When it's wrapped inside the IRA, I lose a lot of those benefits and the exit can be a nightmare. I started in this career when a friend of mine inherited his mom's IRA when she passed away. And at the time, you could do a lifetime or a 5-year distribution. So he did it over 5 years on top of his own income. And so the tax deferral that we talk about and the tax savings that we hoped for didn't exist because he took it all out in such a short period. And now the IRS requires it, like you said, over 10 years on top of your existing income. It actually can turn into a tax nightmare. But I think what you guys are doing is great. I think the education side of showing consumers how to control what they're doing is a great first step to creating success in their lives. And I still think you guys should double your prices.
All right. I appreciate it. I mean, and my thoughts, I mean, obviously, I think for someone who doesn't have an IRA, doesn't have a 401k, and has money to start with, yes, there are going to be other options they have that could be more tax advantageous to them than just putting it in an IRA account. Absolutely. I mean, there are Roth IRA accounts which are tax-free vehicles as opposed to regular IRAs that might be the alternative to that thought. But my mantra, kind of always talked about, is not. A lot of people have 401ks by default. They might have a pension plan by default based on where they work, and the money is put into those plans regardless of their choice. And if you have money in those accounts, it's good to know you have options. And that's where we kind of come into the picture.
Totally,
but if you're looking to start off, if you're a sole proprietor, just someone who has some cash laying around, maybe an IRA isn't right for you. Talk to your tax advisor and see what other options you'd have. But if you do have an IRA or you do have an old 401k, that's where you at least learn about what we do, so you know that you have, like I said, you have other options out there.
A couple questions. A lot of individual business owners have what's called a SEP IRA.
Sure.
So the contribution limit is much, much higher. Can you turn those into self-directed at some point?
You absolutely can. So any type of IRA can be self-directed, whether it's a traditional or rollover IRA, a Roth, or a SEP IRA for self-employed individuals. We also offer a solo 401k plan, where you can, again, it's larger contribution limits, larger deductions for your business. With the solo 401k, you have the potential to make very large Roth contributions. When for really quick for the, again, high-level view, a Roth IRA is a tax-free investment vehicle. As you make contributions to a Roth account, you do not get a deduction up front. And by virtue of not foregoing that deduction, you get completely tax-free growth. And the Roth solo 401k, you can put upwards of 30 grand a year
Is there an
tax-free
income
into a
limit for a
Roth
Roth
solo
solo
K.
for Roth solo? No
That's the
income
beauty
limit.
part. No, there is an income limitation for Roth IRAs, where you cannot contribute, but for Roth solo Ks, there is no income limitation at all.
I definitely like that idea. What about so when you talk about this, do most of the clients, is it a rollover account, or like what percentage of your clients are starting in a self-directed?
Probably less than 5%. And the majority of those are people starting either a self-directed SEP or a self-directed solo 401k where they can put a larger amount in. Other than that, most of the accounts we see are individuals who, yeah, have rollovers. They have old 401ks, old 403bs, 457 plans, or just IRAs that they've had over the years, and they've come across a new investment opportunity they'd like to participate in, and these are the funds that make sense to them. They don't want to touch their maybe emergency fund or their savings fund, but they don't want to miss out on the investment, so they use their IRA to not only to again take advantage of the investment itself, but then also still maintain the emergency fund or the savings account that they have.
I love it, man. Do you know who Peter Thiel is?
Absolutely, founder of PayPal.
Do you know his story about his Roth?
Yes, he took some of his initial shares in PayPal inside his Roth IRA, and because of that, he is now talked about quite a bit when it comes to retirement industry reform for I think for the worst, because he's the exception to what most people are just trying to do, which is, hey, I'm trying to take my IRA, I have some money, I want to grow it. Yeah, I'd love to get to a $500,000 or $1 million IRA, much less his 5 billion or whatever he has in his Roth.
Yeah, he's got
So
like
yeah.
$5 billion now in that Roth.
Yeah, he's the
So,
poster boy for that they like to make as the bad boy of why they need to curtail what you can do inside an IRA. And again, he is the one. There's maybe only a couple other people, Peter Thiel, Mitt Romney, the founders of Google, who have done similar things like that. But for the average person, they don't have access to that type of
yeah,
that investment. So
leave it to the government to change the rules midway though.
correct.
Wow, Scott, I learned a lot today. I think that helping clients understand the options that are out there is always great. You guys do a great service. I don't know how you're surviving with $300 a pop.
It's a volume business. We have over 3 billion in assets that under custody that we administer, and we have over 13,000 active accounts. So it's a volume business for us. We've been growing steadily over the last probably 5 or 10 years, and doing getting opening new offices, hiring more people. Yes, because more people are finding out about what's possible.
Yeah, I love it, man. Well, we'll make sure that there's links in the description below. Scott, thanks so much for being here, man.
Great. All right, Matt. Appreciate it. Thanks for having me on.
All right, see you, everybody.